Hey everyone, this is Kirk here again at optionalpha.com, and welcome back to the video trading alert recap that we do each and every night here on the website for our members. We go over all of the trades that we made today, both opening and closing orders. So again, if you haven't signed up for a membership here at optionalpha.com, go check us out. This is only available for members, and then after that we post it publicly on YouTube about 5 to 7 days later. So you can't take advantage of any of these trades without signing up for a membership first. So today we were a little bit more busy on the opening side. We are hedging some trades that we currently have, and we're going to go over that in detail tonight. I know a lot of people have questions on hedging, how to reduce risk, how to potentially squeak out profits with trades that go against you, and that's what we're going to talk about here tonight. But we also did have a closing trade, and I want to go over that too because we are starting to leg out of an iron condor that we had on P, which is Pandora. So I'm going to go over that one first, and then we'll talk about the opening trades that we had. So like I said, we legged out of the one side of the iron condor that we had on P, which is Pandora. So originally we had an iron condor, the 38.40 calls, and then the 30.29 puts on Pandora. Now, as the markets kind of come down and Pandora's volatility has come down a little bit, we've seen that actually the call side, the 38.40 call spread that we have, come down dramatically in premium. So what we did today is we took off just that side of the trade. There's only 10 cents left. We're getting closer to February expiration, so it's time to start taking off some of these trades, kind of treating each side as its own individual trade in this case. And so we took that trade off, buying it back for a 10-cent debit and making $46 per vertical spread that we bought back. So at the end of the day, this ended up being a really good trade on that side of the market. What we are left with Pandora is actually the 30.29 puts, which are below the market. So we had a huge, really volatile day here today with Pandora and earnings, and we definitely expect that volatility to continue, but implied volatility will continue to drop, and so that's what we're really hoping for. With our first strike at 30, that puts our line in the sand right about here on the chart. So we still have a little distance between us and the market, and that's good, and we just want the market to at least drift for a little bit as implied volatility goes down and or go up. So we have two instances where we can make money on this trade, and we're going to hold this trade for a little bit longer, but try to get out of the trade definitely before February expiration. We don't want this thing to continue on too long. Sometimes when earnings happen and they're not good and the stock gaps down, we tend to see the stock drift lower as it heads towards expiration. So we don't want to get caught in that instance right there, but we also do want to leave an opportunity to still make some money on the put side of this trade before expiration. So moving on to the other trades we made here today, I want to talk about the two hedges, but before I do that, I want to go over COP, which is ConocoPhillips, and I want to talk about that trade because we bought a put spread, sold a vertical put spread on this one. We sold the 62.5 60 put spread, took in a nice credit of $62 per spread that we sold, so a little over 120 bucks is what we took in on this spread. But again, why did we choose the put side as far as selling a spread versus buying a call spread, something like that? Well, you'll notice that ConocoPhillips has had a huge drop in its price, and really for the last 3.5 months, we've just continued to move lower and lower and lower. But as it's moved lower and as it's gone through earnings, we also have noticed that implied volatility has stayed above the 50th percentile. And so right now it's at the 60th percentile. So what that means is that we're starting to look at all strategies that have to do with selling net premium. So we're not looking at buying option premium. We're not looking at debit spreads or calendars or anything like that that takes advantage of a rise up in volatility. Volatility is already high. We want to take advantage of a drop in volatility. So because of that, and because of the just underlying assumption that, okay, at some point between now and March expiration, ConocoPhillips has to rebound here a little bit. Well, at least that's our assumption. We don't know what's going to happen. You can use technicals and all the other indicators out there, but we're just playing the opposite side of this trade and being a little bit more of a contrarian here and selling the put spread below the market. So that's why we entered the put spread. That's why we did a credit spread versus any other type of strategy. All right, so let's get into some of the meatier trades that we made here today. Twitter had earnings today, and who would have known, but earnings were not that great for Twitter. Again, it's just dumb luck if you're on the wrong side of the trade, in which case we were. But that doesn't mean that we can't still work at the trade and hedge it out. So we had a couple put spreads below the market for Twitter, anticipating that volatility would drop, which it did. but also that Twitter might at least pop up higher considering the huge run that it's had recently, that people would buy into this earnings. And they didn't, and that's okay, and we kept our trade size small. But what I want to talk about is how we hedged the position that we already had. So I want to go over that in detail, but let's talk about the actual trade itself. So I already told you that we had two different vertical put spreads below the market at different strikes. Well, now today we went back in, and since Twitter dropped, we went in and sold a vertical call spread against those two positions below the market. And we matched the number of contracts, and you'll see as I go over this with the Analyze tab here in a second, that we matched the number of contracts. So again, we're keeping this a risk-defined trade on both ends of the market, but also giving us an opportunity to possibly make some money or at least reduce our max loss. And so by doing that, we sold the 55-60 call spread, took in a credit of 80 cents per spread. So again, that helps reduce our cost basis on this trade and leaves us potentially with an opportunity to make some money. So what does this all look like, right? Well, let's go to the actual Analyze tab. And what I have up here, and again, if you haven't used the Analyze tab, don't know what it is, I've got a ton of video tutorials right inside the membership area for you guys to check out. But right now, this is what our profit loss diagram looked like before we entered the hedge. And it's looking like this kind of step spread. So we have two different spreads, and that's what creates these two steps in the spread option profit loss diagram. But considering that Twitter has moved down to 50 roughly, that's where it closed today, you can see that the spread is deep in the money on both ends. And we're looking at a max loss at expiration before we made the adjustment of just about $700, $687 to be exact. So what we did is we went back in and sold the 55-60 call spread against this position. And so when I add those two strategies back to the profit loss diagram, you'll notice that our profit loss diagram changes from what it was before to this, kind of like almost this weird looking butterfly spread. But it's really an iron condor, it's just inverted. And so by doing this, Twitter is still trading here right at 50, right where I'm drawing this line right now. And that reduces our max loss if Twitter were to trade here or below to $367. So we've almost cut our losses in half by reducing our risk and adding this hedge to the position. Now from here, we actually make money if Twitter continues to trade higher and closes right around 55. Now it's a small window of opportunity, and I understand that, but what you have to understand is that from here, $50, all the way to $55, our loss gets reduced and reduced and reduced, and we actually have a very small opportunity to make some money. Now this is before we make any other adjustments. Who's to say that Twitter doesn't continue lower and we actually continue to sell call spreads or put spreads against this position? We have a lot of dry powder here, and that doesn't mean that we can't stop with this one hedge. But I just wanted to show you guys how we're using this hedge to our advantage. It's not that Twitter went in the money and you just write off these trades as, oh, well, it's a max loss, etc. You got to work at these. And the best traders out there work at these positions, and they spend their time focusing on adjusting and hedging the positions that go against them more so than they adjust and hedge any other position that's favorable or profitable. So hopefully that really helps out understanding why we made this trade adjustment. Again, it's not to say that this was the only adjustment between now and expiration. Twitter is very volatile, so things can happen very quickly, and we can be in and out of a couple different spreads between now and expiration, very similar to what we're already doing with Google, and that's paying off big time. So the last one we want to look at here tonight is LinkedIn. So LinkedIn had earnings, and so what we did is here, just go ahead, and we already had a put spread below the market, or I'm sorry, we already had a call spread above the market. We wanted to go ahead and make this a very even, wide iron condor right before earnings. Again, usually earnings will result in a volatility crush, so volatility will drop dramatically after earnings. And what we did is went in and sold the 205-200 put spread for a $140 credit per spread. If we match our number of contracts, which we did, so we have an equal number of put spreads as we do an equal number of call spreads, and we match the width of the strikes, which we did, so it's only $5 wide, then by adding this credit of $140 per contract, it didn't cost us any additional margin or risk because the market can't be on both sides at the same time. So by having this, we now have a very wide iron condor on LinkedIn. And actually, I have no idea where LinkedIn's trading right now. I know that it had earnings, and you can see that earnings were actually bad. So it traded down to pre-market, or at least post-market here in the evening. It's trading at right 05, so it was trading at 223 at the close here today, and I'm literally seeing this right when you guys are. I don't follow this stuff all the time. I'll take a look at it here in the morning, but it's already trading down about $15. So where does that put our position, right? Well, we know that there's going to be a crush in volatility, but we have the 205, so that's right on our doorstep. This 205 put spread that we just sold, who knows what LinkedIn earnings could have done. We obviously would have made more money if we hadn't entered this trade, but who's to say that LinkedIn didn't shoot through the moon and have great earnings heading into this month. So by doing this, by having this wide put spread, what we'll likely do, now that it's on our doorstep, is see what happens on the open tomorrow. We'll obviously close out the call spread that we have and try to work with our put spread, possibly even roll down the call spread to something a little bit closer, maybe 215, 220, one of those put spreads as well, and continue to work at narrowing down our profit and loss diagram for expiration. So hopefully you guys understand how that works. As always, if you have any questions at all, please add them to the comment section right below the video, and happy trading.